The clock strikes 9:30 a.m. on Wall Street. As phones start ringing, screens begin to glow red. In just a few hours, billions of dollars will vanish, not because of war, not because of a natural disaster, but because of something invisible, an idea, a line of code, K, and a market that suddenly loses control of itself. To understand Black Monday, you have to go back to the early 1980s, a time when the United States economy was coming out of a painful recession. Inflation had been crushed, interest rates were falling, and confidence was returning. Money started flowing back into stocks. The Dow Jones Industrial Average, one of the most watched stock indexes in the world, began a powerful climb. From 1982 to 1987, it more than tripled in value. Investors felt like a new era had begun, one powered by technology, global trade, and financial innovation. But the market itself was also changing. The trading floors were no longer just filled with people shouting orders. Computers were stepping in. Banks and investment firms began using software to make decisions faster than any human could. This was the birth of automated trading on a massive scale. One of the most important tools of this era was called portfolio insurance. It wasn't an actual insurance policy. It was a strategy built on algorithms. It's designed to protect large investors from sudden losses by automatically selling stocks when prices started to fall. On paper, it looked safe. In reality, it created a hidden risk. By 1987, optimism was everywhere. Stock prices were rising month after month. Individual investors, pension funds, and major institutions were all buying in. Corporate profits were strong. The US dollar had been falling, which made American exports more competitive overseas. Global markets were becoming more connected, and money was moving across borders faster than ever. Wall Street believed it had found a way to grow without fear. If prices dropped, computers would sell automatically and protect portfolios. If prices rose, investors would ride the wave higher. This system encouraged even more risk-taking. The belief spread that crashes were a thing of the past. That technology had tamed the chaos of the market, but under the surface, pressure was building. Interest rates were starting to rise again. The US government was running large budget and trade deficits. Overseas markets, especially in Europe and Asia, were showing signs of weakness. These were small signals, easy to ignore, till the chain reaction began. In the days leading up to October 19, 1987, stock markets around the world started to slide. Hong Kong fell sharply. Europe followed. When US markets opened, fear was already in the air. At first, it looked like a normal correction. Prices dipped. Some investors sold. Then the computers took over. Portfolio insurance programs detected the drop and began selling large blocks of stock automatically. That selling pushed prices lower. Lower prices triggered more selling, and more selling triggered even more selling. The system that was designed to protect the market was now accelerating its fall. Traders on the floor tried to keep up, but the volume was overwhelming. Phone lines were jammed. Orders piled up. Prices moved so fast that no one knew what anything was really worth anymore. Confidence, the invisible foundation of every financial system, began to break. By the end of the day, the Dow Jones Industrial Average had fallen 508 points. That may not sound large today, but in 1987, it was a drop of more than 22% in a single session. It was the largest one-day percentage loss in the history of the U.S. stock market. Around the world, markets followed. Australia fell more than 40% over 2 days. The United Kingdom dropped sharply. Canada, Hong Kong, and many European exchanges suffered massive losses. Banks and financial institutions worried that the system itself might fail. If firms couldn't settle trades, or if investors lost trust in the markets, the entire financial structure could freeze. But something different happened. The U.S. Federal Reserve, led by Chairman Alan Greenspan, made a critical decision. It announced that it would provide liquidity to the banking system. In simple terms, it told banks, money will be available. The system will keep running. That message calmed the panic. In the weeks that followed, markets slowly stabilized. The U.S. economy did not fall into a recession. Banks did not collapse. But the shock left a permanent mark on financial history. Individual investors who had panicked and sold at the bottom locked in their losses. Long-term investors who stayed in the market eventually recovered as prices rebounded over the following years. Regulators and exchanges took action. New rules, called circuit breakers, were introduced. These rules automatically pause trading when prices fall too fast, giving humans time to react instead of letting computers drive the market into a spiral. The event also changed how people thought about technology and finance. Computers were powerful, but they were not neutral. They followed rules, and when many systems followed the same rules at the same time, they could move the entire market in one direction. Black Monday became a case study in how fear, automation, interconnected systems can combine into something larger than any single decision maker. On October 19, 1987, the world learned that markets don't just run on money. They run on confidence, on trust, and on the belief that tomorrow will make sense of today. When that belief disappears, even for a few hours, the numbers on a screen can turn into a global shockwave. Black Monday wasn't just the day markets fell. It was the day the modern financial world realized how fragile its own systems could be.